Good evening and a very warm welcome to yet another knowledge sharing session organized by CA Sansaar. Today we have with us CA Vivek Khurana, who we all know is the founder of CA Sansaar. And our speaker for the evening is CA Shweta Milani Doshi, who shall be sharing her knowledge on IND AS and its applicability. Few words about a young and dynamic speaker. Shweta holds a diploma in IFRS by ACCA UK and has also completed a certificate course on forensic accounting and fraud detection conducted by ICAI. Her achievements include All India rank 37 in CA intermediate exam. She has conducted more than 20 plus IND AS seminars for listed companies and various corporates. She is also actively involved in providing training to ICI students. She is currently partner in Doshi RC and Company and is heading internal audit, valuation, and IND AS division there. We welcome you, Shweta, and hope to have a very knowledge-enhancing session with you. Now I hand over to Vivek ji for a formal welcome to Shweta.
Thank you very much, Neha ji, and a warm welcome to all of you on this webinar on overview of IND AS and applicability. And I hope everybody is fit and fine because time is very crucial nowadays, and I hope so. And my sincere thanks and a warm welcome to Shweta ji, as rightly said by Neha, very young and dynamic speaker we have. And when I called her, and I was not aware she is so young. Yesterday she sent her pic. Then I said कि बच्चों वाली pic मत भेजो. Send me a matured pic. And anyway, thank you very much for sparing your time and giving your valuable time. And because the topic is very, very important nowadays, this IND AS. Even recently, RBI has notified regarding the NBFC to for the applicability of IND AS. And now, without wasting any time, now it's over to Shweta ji to please guide us regarding the IND AS, its applicability, and regarding how it's different from the IFRS. So it's over to you, Shweta ji. Thank you very much.
Yeah. Thank you, Vivek sir, and thank you, Neha ma'am, for your kind words. Good evening, everyone. I am CA Shweta Milani Doshi. Today, I am going to cover an overview of IND AS and its applicability. I will also cover what are the ITFG issues published along with it. So I'll try my best to give you all the guidance or all the knowledge in a very simplified manner so that whenever you read a IND AS financial statements, you understand thoroughly what is mentioned in that financial statements. It shouldn't be like you're unaware about what is IND AS and you're not yet updated, you're not understanding these financial statements. It should not be the case. So in this next 1.5 hours, I'll try my best to give you guidance upon each and every topic in a very simplified approach. So beginning with IND AS, now every one of you know that IND AS has been adopted by IFRS. So first you will understand what is IFRS, what is its structure, and how did India adopt to IFRS. Friends, IFRS is a set of standards issued by IASB. IASB is nothing but International Accounting Standard Board, which issues standards on which are called as IFRS. Now, whenever you'll go through the standards issued, you might see those are IFRS and IAS also. People confuse whether IAS is Indian accounting standards and IFRS is International Financial Reporting Standards. That is not the case, my friends. IAS is also International Accounting Standards and IFRS is International Financial Reporting Standards. These initial set of standards issued by IASB were renamed or were numbered as IAS1, IAS2 in this structure. And the subsequent standards issued by IASB in combination with IASC, these were called as IFRS. So please don't confuse IAS as Indian accounting standards. These are nothing but international accounting standards. Further, IFRS also issues certain guidance which are called as IFRICs. So IFRICs are nothing but your advisory opinions or your expert opinions. How in India, we had a team called as EAC team that was called as Expert Advisory Committee. So in such form, even in the international market, or in international standards, they have a concept called as IFRS and SICs to provide additional valuable guidance for the things which are not able to be applied in a simplified manner. So IFRS are nothing but your expert advisory opinions issued by the bodies, by the setting bodies. Further, how in accounting standard we had the bold and italics paragraphs as the important part of the standard, and the rest of the paragraph was the explanation towards the bold part. In IFRS, there is no division between the bold part of the standard and the normal part of the standard. Every part of the standard is having an equal relevance. Why is this important is you should understand how to read the particular standards and how to apply them. If the significance is not achieved, you won't be able to apply the standards very appropriately. So this was about the IFRS. Globally, many countries have applied IFRS and they have adopted IFRS as it is. Similarly, in 2007, India was thinking to apply IFRS since 2007. So in 2007-2008 regime, India tried to bring in the notification for application of IFRS, for which the IFRS was first time applicable on 1st of April 2011. That was the first year in which the India had issued a notification with respect to application of this IFRS. Now, in India, what was the case is they did not want to apply the IFRS as it is. However, it is issued by the international issuing bodies. India changed or converged this IFRS as per the Indian scenarios and accordingly brought up a converged IFRS called as IND AS. So this notification was first time issued as applicable on 1st of April 2011. But during that period, there were so many hurdles. The tax was not coinciding. There were no guidance on the important standards or on the complicated standards such as financial instruments. Even internationally, these standards were issuing changes or they were undergoing certain changes. So for the roadmap was only applicable for the SEBI. The SEBI had only issued the roadmap for only listed companies. So it was not very clear and structured in a structured format. Many companies also denied applying this IFRS due to lack of preparedness at that point in time. So at that point in time, MCA deferred the application of IFRS to the subsequent period. And at that point of time, they didn't even announce to which financial year this application is deferred. So in the year 2011, it was completely like there was no visibility when this IFRS is going to be applied in the Indian scenarios. Subsequently, in February 2015, MCA issued a notification for applicability of converged IFRS, which are called as IND AS. So all these standards were notified by MCA. The guidances or the IFRICs, which I previously explained, which are nothing but the advisory opinions or expert advisory opinions, these were also brought in as a part of our standards in IND AS. And a complete set of standard was issued by MCA, and a roadmap for applicability of such IND AS was given to the Indian companies. And accordingly, they had issued phase-wise roadmap for the purpose of application. So in this form, there was a phase from which there was no visibility about application of IND AS to a phase where the application was brought into the live process and the MCA had issued proper notification which network to use, which criteria to use, to which companies it is applicable, for which companies phase 1 is applicable, for which companies phase 2 is applicable, what to do about the subsequent accounting. Everything, guidance on everything was given by MCA in 2015. So in this entire session, subsequent session, we will understand first of all what is applicability of IND AS. Now, friends, in this notification issued by MCA had defined two phases which were preliminary dependent upon the net worth of the companies. So based on the net worth, the MCA decided for which companies this IND AS should be applicable, and accordingly also decided how to converge with the standards, and if any companies fall into this phase in a subsequent period, in such cases what has to be done. So let's understand this. Now, on 16 February 2015, MCA issued the notification which said that if a net worth of a company is equal or greater than 500 crores, such companies fall under the phase 1 of the IND AS convergence roadmap. Now, what does this phase 1 mean? These companies have to publish their first IND AS financial statements on 31st March 2017. So 2016-17 was the first year of application for the phase 1 companies. Now, subsequent phase was, or phase two was, any company which is a listed company. So in short, all listed companies and the companies whose net worth is about 250 crore, for such companies, the first reporting financial year under IND AS was financial year 2017-18. Now, these two phases are already over. So in 2016-17, India saw its first IND AS financial statements. Now, there are various peculiarities involved in this definition. What is the net worth criteria? What to do if IND AS is initially applicable and subsequently you're not meeting the net worth criteria? So let's understand this thing clause by clause. The MCA said that at the time of issuing the notification on 16th of February 2015, MCA said that the net worth position as on 2014 has to be considered for the purpose of this applicability. And if any company meets the net worth criteria as on that date, the IND AS has to be applicable. So what does it mean? If as on the date of applicability, the company is meeting the definition, the company has crossed the criteria of 500 crores, IND AS has to be applied in the financial year, or the company has to publish its financial statements under IND AS in the financial year 2016-17. Even if subsequently the net worth reduces, the company is not waived off from the applicability requirement and the company has to publish its financial statements under IND AS. Similarly, for the phase two companies, similar net worth criteria was given. If the company is meeting the criteria as on the date of applicability, the company has to publish its first IND AS financial statements in the financial year 2017-18. Now, friends, this is the past. All the companies to whom the IND AS was applicable in 2016-17 and 17-18, they have already published their financial statements as on the respective dates. What about the subsequent companies? If any company meets the net worth criteria, suppose I cross the net worth criteria as on 31st March 2019, in the immediate subsequent year, I have to publish my financial statements under IND AS. So, for example, if my financial statements as on 31st March 2019, after adding up the profit, has increased the 250 crores criteria. Okay, so in such cases, the IND AS will be applicable from the immediately subsequent financial year, which is 2019-20. So this is the case. You don't have any exemption for this. In case of listed companies, if the IND AS is applicable in the subsequent year, from your first quarter itself, you have to publish the results under the IND AS. So this is the case. So for every companies now to whom you are a practicing chartered accountant or in a company which you are into employment, please check as on which date the net worth criteria is probability that the net worth criteria will be met. Because in the immediate subsequent year, you have to disclose the financial statements under IND AS. So this was all about the corporate roadmap, friends. And what are the implications to this roadmap? Let's also understand in detail. The notification or the MCA notification also said that if any company is covered under the IND AS due to this net worth criteria, in such cases, any company which is a holding company, subsidiary company, associate company, or a joint venture company shall be covered in this IND AS roadmap irrespective of their net worth criteria. So what does this mean? If I am the company which is covered under the IND AS due to the net worth criteria, all my related companies which are associates, joint ventures, subsidiaries and holding companies, even if they are below 250 crores, even if they are having net worth of hardly 10 crores, will be covered in the applicability framework. And this is very important, friends. In my entire experience of past 5 years of application of this IND AS, specifically in case of subsidiaries, people tend to they miss out for the applicability of IND AS, because in case of associates, you are not aware about what is the net worth of the holding company. You just send your financial statements on a particular date to the holding company and you do not keep a track. So accordingly, it is very important to have a track of the net worth of the holding company, because once it is applicable to the holding company, it is applicable to the associate company also. And we have seen defaults made by listed companies even who were a associate of a holding company which crossed the net worth and they did not publish the results under the IND AS. So this linked criteria is very important for us to understand. Otherwise, you will skip on to application for such linked companies. And the most important thing is that these companies should not, it is not necessary whether they're meeting the net worth criteria or not. Now, friends, this roadmap of 2015 or 2016-17 and 2017-18 was a corporate roadmap. The MC or the respective bodies have also issued a roadmap for the NBFC companies. The criteria are the same. They have defined the phase 1 applicability. First time was applicable in financial year 2018-19, and for phase 2 companies the first time applicability was on 2019-20. So this financial year of 2019-20 is the first time application of IND AS for the second phase of NBFC companies, which means which are crossing net worth of 250 crores or which are listed NBFC companies. So this is about the NBFC companies. Further, for the purpose of banks and insurance companies, the IND AS is still deferred. So the RBI had continuously started issuing notifications for applicability of IND AS to banks. Many companies tried the application also. They had to send the draft financial statements to RBI for the purpose. But there is lot of lack of guidance for the purpose of application to the banks and the insurance companies, and that is why the deferment is required, and India's application is not smooth how it was for the corporates, and accordingly for the purpose of banks and insurance companies this applicability was deferred. Now this was the plain understanding of the definition. Let's go into the further criticalities, friends. For the purpose of determining the net worth, what should you consider? Should you consider net worth as per the Companies Act? Should you consider net worth as per your normal accounting principles? Should you consider net worth as per Income Tax Act? As per what should the net worth be considered? The definition of net worth is different under various acts. So that is why it is very important to understand what is the definition of net worth. So this definition says that net worth is nothing but your capital, your share capital, plus any kind of reserves which are formed out of profits. It also is deducted by any kind of accumulated losses, any kind of deferred expenditure recognized as asset in the balance sheet, and also any kind of miscellaneous expenditure which is shown as an asset in the balance sheet. So to summarize this thing, it is nothing but your share capital plus your reserves created out of profits, plus it is deducted on account of accumulated losses, deducted on account of your miscellaneous expenditure. Ideally, it is from a long time this miscellaneous expenditure which is shown as an asset in the balance sheet. So this is about the applicability of IND AS. If you have miscellaneous expenditure as an asset, you have to deduct it from your net worth criteria. And further, you have to also deduct any kind of deferred expenditure capitalized in the balance sheet. So these were about the reserves. And further, friends, there are also some included in the definition. So which are to these reserves? Revaluation reserve. So revaluation should not be included in the definition of the net worth. Further, any kind of reserves created is not to be created in the definition of the net worth. So this is about the applicability of IND AS and the net worth definition. We also saw on what date this net worth definition has to be considered. So moving ahead to the next part of the of our session. To understand the standard well, we'll also understand the structure of the IND AS. How is the IND AS structure defined? Which all standards are there? What to do or how can you compare it with your accounting standards? And how to compare this with the IFRS. So let's understand the structure of IND AS in detail form. So on and whole, there are 41 accounting standards which are issued under IND AS regime. So these 41 standards also includes 3 standards which are replaced by new standards. So let's understand the standards one by one and how it is linked with the IFRS and how it is linked with the accounting standards, our old Indian GAAP. So friends, one more logic or one more important concept I would like to explain is, in case of IND AS, how to link it with the IFRS standards. Wherever the number is IND AS 1, you have a corresponding IFRS standard which is called as IAS 1. If it is IND AS 2, you have a corresponding standard which is IAS 2. But in cases where you have IND AS 101, you have a corresponding standard called as IFRS 1. IND AS 102 has a corresponding standard called as IFRS 2. So all the IND AS which are below the 100 series has a corresponding IAS of the exact same number, and the IND AS which are above the 100 series, 101, 102, 103, have the replica IFRS series called as IFRS 1, IFRS 2, IFRS 3. Why understanding this is very important, friends? Because at the time of application, if you face any issues, you should be well versed about how to search it into the IFRS regime. If there is any additional guidance under IFRS, if there is some of the publication under IFRS. So that is why it is very important for you to understand how to correlate the standards with the IFRS standards. So they have kept the entire numbering same. Only the difference they have made is IFRS has been numbered as above 100 and IAS have been numbered as the below the 100 series with the exact same number. So this is a very good move that the government has made. So let's go into the standards one by one. Now friends, under IND AS, and when we will understand the standards, I will also explain you in short what are the differences or what are the core principle oriented differences between these IND ASs and the corresponding accounting standards. So on a whole, at least you will get an idea about how these standards are different from your accounting standards. And wherever there are very minimal differences, I'll just mention that there are very minimal differences under this standard, and you can apply it. I mean, the application does not result into the major differences as compared with the Indian gap. Now, starting with the first standard, which is called as IND AS 1, presentation of financial statements. This standard gives a guideline about what are the financial statements, what are the components of financial statements. I will also discuss the components of financial statements in a very detailed manner in my subsequent slides. And what are the concepts to be used in the while preparing the financial statements. So each of these concepts have been disclosed in the IND AS 1. And there was also a similar standard under your Indian gap also. Subsequently, the second standard is IND AS 2. You also have a complementary standard or a corresponding standard in AS, which is AS2. Compared to IND AS 2 and AS2, there are very minimal differences. There is only a slight difference in the scope, in the coverage of the standard. Other than that, on a whole basis, there are very few differences or ignorable differences, which is for application of IND AS 2. Third is IND AS 7, statement of cash flows. You also have a corresponding standard under AS. One of the important difference while comparing IND AS 7 to the AS 3 is nothing but your determination of cash and cash equivalents. Under IND AS 7, even your bank overdraft has to be reduced at the time of computation of your cash and cash equivalents. So in your cash flow statement, the bank overdraft is reduced from your cash and cash equivalents, and accordingly the balance is reduced and it is not shown in your changes in working capital. So this is one of the very important difference. Subsequently, you have IND AS 8, accounting policies, changes in accounting estimates and errors. Even your accounting standard has been brought in line with this standard. One of the important differences, your estimates, that is your change in estimate of depreciation. Your depreciation is no longer a change in your change in policy, but it is a change in estimate. So in this form, every standard has a difference as compared to your accounting standards. The most important differences are in the standards of revenue recognition, in the standard of leases, in the standard of deferred taxes, and in the standard of financial instruments, which is one of the most important standards. If you'll see, friends, here there is a standard called as IND AS 11, construction contracts. This standard was previously issued by MCA when the first roadmap was issued. Subsequently, this standard was replaced by IND AS 115. So currently, in practice, for the purpose of revenue recognition, you have a standard called as IND AS 115. This standard was first time applicable on 31st March 2019. And whenever the companies converged for the first time, phase 1 and phase 2 companies, they had applied IND AS 11 and IND AS 18 for the purpose of their application. Then you have IND AS 12, which is called as income taxes. Now friends, in these standards, that is the computation of deferred tax, there are various differences or there are logical differences as compared to your accounting standards. You have a difference between the basic logic of computation of deferred tax. So under IND AS 12, you follow a balance sheet approach. And here I'm giving you overview of all the differences so that you get a glimpse of all these standards. So under IND AS 12, you have been given a balance sheet approach for the purpose of computation of deferred tax. And they have also given various guidance how to recognize deferred tax in your consolidated financial statements, how to recognize deferred tax on unrealized profit on inventory, how to recognize deferred tax on investment in subsidiaries, investment in joint ventures, investment in associates. So such detailed guidance has been given under IND AS 12, which was not given in detail form under your previous standard, which is called as Indian accounting, Indian GAAP. It was not given in that detail form. Then you have IND AS 16. So friends, you might be also aware that your AS10 has been also bought in line with your IND AS 16. So on an whole basis, after the MCA revised AS10 or the revision was bought in AS10 by ICI and subsequently adopted by MCA, the AS10 or revised AS10 is more in line with the IND AS 16 and there are no longer any differences compared to the IND AS 16. Then, friends, there is a standard called as IND AS 17, which is leases. This standard was very much similar to our Indian GAAP standard, but subsequently, this standard has been replaced by IND AS 116 leases. And when you compare the accounting given under IND AS 116 and vis-a-vis corresponding AS 17, corresponding AS in the Indian GAAP, there are many differences under these standards. So there is a complete change in the way in which the leases are accounted. 116 leases are accounted in the balance sheets. Appear in your balance sheet asset. Your leases appear in the balance sheet. So this is a classic difference. Under IND AS 116, no longer your rent expenditure is shown in the statement of profit and loss, but you have an expenditure called as depreciation and interest. So in spite of the fact that you're entering into lease arrangement, still you don't have a component called as rent expenditure in your P&L, but you have interest and depreciation. What is accounting for it? You have to discuss detailed IND AS 116, but I'm just trying to give you a glimpse of each and every standard. Then friends, there is a standard called as IND AS 18, which is for the purpose of revenue recognition. This standard was also replaced by IND AS 115. So previously there was two standards which are called as IND AS 11 and IND AS 18. These both standards have been replaced by IND AS 115, which is called as revenue from contracts with customers. So in IND AS 115, what is the basic concept? We'll discuss in the detail form in the subsequent slide. Then you have a standard called as IND AS 19 for the purpose of employee benefits. So one of the important differences which is given under the employee benefits is how under the Indian GAAP we used to recognize the entire component of gratuity in the statement of P&L. So whatever is the provision for gratuity, we used to recognize in the P&L as employee benefit expenditure. Whereas under IND AS, you have to recognize actuarial gains and losses separately. And these actuarial gains and losses are to be recognized in OCI. What is OCI? I will discuss in detailed format in the subsequent slides. So this is one of the major practical differences. Any company which is converging into IND AS for sure will have this difference when they will converge to IND AS, because many companies or majority of the companies have the provision of gratuity which they measure using the actuarial valuation. So if they're measuring their provision for gratuity using actuarial valuation or any other long-term benefits using actuarial valuation, in such cases, they have to transfer the actual gains and losses to the statement of other comprehensive income, which is called as OCI. Moving on to the next standard, which is called as IND AS 20, accounting for government grants and disclosures of government assistance. So in this standard also, there are very important differences compared to your previous Indian GAAP. Under Indian GAAP, you had a concept of promoter's grant. Under IND AS, there is no concept of promoter's grant. Each and every grant received by the government has to be mandatorily classified into asset related grant or income related grant. Other than this, you don't have any other classification for the purpose of IND AS 20. So this is one of the major differences compared to the previous Indian gap. Further, you also have a guidance on the government assistance. What is a government assistance? What are to be classified as a government assistance? And what are the disclosure requirements for the purpose of government assistance? So, when you will classify a particular assistance as a government assistance, there is no kind of accounting required, but there are disclosure requirements. So, this is very important. Moving on to the next standard, which is IND AS 21, the effects of changes in foreign exchange rates. You had a corresponding standard called as AS11. In AS11 and IND AS 21, conceptually everything is similar, but there is an important concept in IND AS 21 is determination of functional currency. So what is functional currency is a currency which is of the prominent importance to the entities. So if a currency is of prominent importance, which currency is of prominent importance to that particular reporting entity? It is the functional currency of the entity. They have given various guidelines for the purpose of determination of functional currency. And if these guidelines are satisfied, that is the functional currency of that entity. So determination of these functional currency changes the manner in which or what kind of foreign exchange differences will be debited to P&L, what will be stated to the statement of other comprehensive income, that is OCI. So everything is dependent upon this determination of functional currency. So this is very important under this IND AS 21. Moving on to the next standard, which is called as IND AS 23, borrowing cost. Under Indian GAAP, also you have a similar standard called as AS16. So what is the difference between these two standards on an whole or on an overview basis? IND AS 23 and IND AS or AS16. So as a concept, there is not much difference. So here also you have conditions for capitalization. Here also you have time limit for the purpose of capitalization, and the concepts are similar, but the capitalization of borrowing cost is determined at or is computed as per the effective rate of return in the borrowings. So what is that is given under the financial instrument standard. So the manner in which you will compute the interest that will be capitalized in your property, plant and equipment has to be determined in accordance with the financial instrument standard. And this computation changes on IND AS, and which is the bigger difference under the IND AS compared to the AS. So what is the difference? Purely it is as per the financial instrument standard. Then you have IND AS 24, which is the related party disclosure. AS, you have a corresponding AS called as AS18. Friends, why I'm telling everywhere what is a corresponding standard? Because under the IND AS regime, you also have certain standards which are completely new in nature. And that is why these standards, wherever they have a corresponding AS, we were discussing in detail. So under the related party disclosure standard, here you have certain important or certain additional relationships which are covered in IND AS 24, which were never there under AS 18. This is the first major difference. And the second major difference is there are certain additional disclosures to be given in the related parties. So what are, for example, such disclosures? For the purpose of key managerial remuneration, under AS, you used to just show it as a single line item. But under IND AS, you have to divide that remuneration into the components. You have to show what is the short-term benefit component, what is the long-term benefit component, what is post-employment benefit component, what is the ESOP component, that is share-based payment component. So the entire remuneration given to the KMPs has to be divided into these 4 or 5 components. And you cannot show it as a single line item in your financial statements. And the relationships, important relationships which are additional over here is under IND AS, all the directors, whether they are independent directors, whether they are non-executive directors, whether they are executive directors, each and every director is a related party to the company. This was not the case in the AS. So under this IND AS, every director is a related party to the company. So this difference also, friends, is applicable to each and every company because previously under AS, non-executive directors were not covered as a related parties. So this is again one of the important change. Then we have IND AS 27, IND AS 28. So IND AS 27 and IND AS 28 is nothing but the standards which are governed for the purpose of recognition of the standard financial statements and for the purpose of determination your investment in associates and investment in joint ventures. So they have given the criteria how to disclose these kind of investments. So what are the differences over here is we'll cover as a conceptual level. Under IND AS 27, you have been given an option. So if you have an investment in subsidiary, you can either recognize it at cost or you can recognize it in accordance with IND AS 109, which is called as the financial instrument standard. So इसका मतलब क्या है? आप वो investment either cost पर recognize कर सकते हो या 109 में they have given your option to fair value that investment at each reporting date. So this can be the option availed by the company. This was not there under your previous AS. This is one of the biggest difference. Under IND AS 28, investment in associates and joint ventures. One of the most important differences in your accounting standards, joint venture आपके books में consolidate होते थे using proportionate consolidation method, friends. So what we used to do is, if sales of your joint venture are say 100 and your share is 50%, you used to show 50% as your own sales. Then, if the assets of the joint venture are say 200 and your share is 50%, you used to show 50% of your assets in your own financial statements and used to add up to the respective line item of the assets. But under IND AS, they have said that whether it is investment in associate or whether it is investment in joint ventures, in both the cases, you have to add up or you have to consolidate these investments using equity accounting method. There is no concept called as proportionate consolidation method under the IND AS regime. And all the IND ASs have to be recognized at the equity accounting method. Moving ahead, there are IND AS 32, which is the financial instrument standard. I will discuss it subsequently. You have IND AS 33, which is earnings per share. More or less, this standard is similar to what is under the AS, so I'm not discussing the differences. Even IND AS 36, impairment is more or less similar to what was your previous standard. So moving ahead to the next standard, which is called as IND AS 37. Provisions, contingent liabilities and contingent assets. Compared to your AS standard, which is AS 29, under AS 29, आप कुछ भी discounting नहीं करते थे. There was no concept of discounting under our AS regime. But under this IND AS regime, any provisions which are long-term in nature or which are non-current in nature have to be discounted to present value. So for example, there are many companies who have provision for income tax, provisions for decommissioning, restoration. I hope you're aware of this concept when you had discussed AS10. The revised AS10 has this concept of provision for restoration, dismantling, and decommissioning. So any kind of provision have to be discounted to present value as on the respective date. So this is one of the most important difference. Again, might be applicable to the majority of the companies because majority of the companies have some or the other kind of provision. You have provisions for warranties. You have any provisions for any particular litigations. All these provisions have to be bought to and disclosed at the present value. Moving ahead to the next standard, which is called as IND AS 38. Now, friends, under Indian GAAP, you have a standard called as AS26, which is compared or comparative to this intangible asset standard called as IND AS 38. In these cases of IND AS 38, one of the new concept what has been brought in under the IND AS is there is a concept called as intangible assets with indeterminate useful lives, indefinite useful lives. So what does it mean is you can have an indefinite useful life for a particular intangible asset. For example, you have goodwill, and in such cases, you cannot decide what will be the recoverable value of the goodwill. So by default, goodwill has an indefinite useful life, and it has not to be amortized. So if any particular asset has an indefinite useful life, in such cases, these assets are not amortized and only are tested for the impairment. So this concept was nowhere there under the AS, and this concept is there under the IND AS, which are assets with an indefinite useful life. So friends, everywhere I'm pinpointing the most important difference. So in my past history of my practical experience, I know which and every standard, which are the differences which no longer have relevance. So even if there's tweak in a definition, if in practical life you have the same application of it, so there's no sense of discussing those differences. That is why all the important and practical differences I'm discussing, so that you get a overview or you get a at least a bird's eye view understanding of the standards. Moving ahead, in days 40, there was no corresponding standard under the AS called as investment properties. Only there was a slight or minimal guidance in AS 13. What does the standard say is any kind of land and building. It only covers land and building. Please note it. Any kind of land and building which are held for the purpose of earning rentals or which are held for the purpose of capital appreciation are to be classified as investment property. So this is the definition given of investment property under IND AS 40. So accordingly, depreciation and everything is there. But what changes is your disclosure in your balance sheet changes. And accordingly, there are also certain additional disclosures required for the purpose of investment properties, which is, for example, you have to show what is the valuation or what is the fair value of your investment property as on the particular reporting date. So if a particular asset is classified as an investment property, by default, in your notes to the financial statements, you have to disclose what is the fair value of that investment property. Now, you also have another new standard which was nowhere there under your Indian GAAP is IND AS 41 agriculture. Under the standard, they have given what is the definition of an biological asset, how to recognize this biological asset. So as per the standard, the biological asset has to be recognized at fair value at each reporting date. So under AS, whoever had the agriculture as a business used to do agricultural accounting on based on various guidances. So under IND AS, you have a particular standard for the purpose of agriculture. Now, moving ahead to the next part. Under the IND AS regime, whenever you're transiting from the accounting standard to the IND AS, all the transition provisions are given under IND AS 101, which is called as first time adoption of IND AS or first time adoption of IFRS. So you have a corresponding standard called as IFRS 1, which was called as the first time adoption of the International Financial Reporting Standards. Then you also have IND AS 102, which is share. Just to cover up in brief, IND AS 101 gives all the requirements how to transit, whether you have certain optional exemptions, whether you have certain mandatory except. I'll discuss that in various detailed format. I have a detailed slide over it in my subsequent session. So that is why I'll just give a light over it and I'll move on to the next standard, which is called as IND AS 102, share-based payments. Now, under your accounting standard, you didn't have a fixed standard on this. You only had a guidance note issued by ICI. But over here, under IND AS 102, you have a specific standard covered under IND AS, which is called as share-based payments. Now, which is the most important difference is, under the guidance note issued by ICI, under your AS, your Indian GAAP, you had an option to fair value your share-based payments, to fair value your ESOP options, or to recognize your ESOP options using two methods. First method was the intrinsic value method, and second method was the fair value method. So these were the two methods given under the guidance note. Whereas under IND AS 102, by default, you have only one method of recognizing the ESOPs. That is only the fair value method. You don't have any other method under IND AS 102. So moving ahead, under IND AS 102, you also have a concept called as group share-based payments. So this is also one of the important concepts. You'll understand it in detail when you'll go into that standard. IND AS 103. Now in IND AS 103 business combinations. So business combinations, over here you have various differences. One of the most important differences, the business combinations have to be recognized at fair value on the acquisition date by default. Under AS, you had two options. You can either do it fair value or you could do it at the book value, which was also called as the pooling of interest method. So pooling of interest method is not there under the IND AS regime. Moving ahead to IND AS 105. IND AS 104 is still in the process of issuing because they are evaluating the application to the insurance companies, and that is why this standard is not yet notified by the MCA. So this is a corresponding standard to IFRS 4. Moving ahead to the next standards called as IND AS 105 and IND AS 106. So these standards are also new under the IND AS regime. You didn't have a corresponding standard under the AS. So this is nothing but the 105 talks about non-current assets held for sale and discontinued operations. So non-current assets held for sale is nothing but they have given certain criteria. If these criteria are fulfilled, then you have to disclose a particular asset as assets held for sale. And once the asset is classified as held for sale, no longer the company will provide depreciation over those assets. So depreciation is completely stopped for those particular assets. This is the most important guidance given under IND AS 105. Discontinued operations, you had a similar standard under AS, and even the guidance given under the standard is also similar to what was there under the AS regime. Then you have a next standard we called as exploration for and evaluation of mineral resources. This is specific to the oil and natural gas companies, mineral resources companies. In this standard, they show us from which date you can start the capitalization of expenses up to which date. So they have given a time frame from which you can start your capitalization up to what date it has to be continued. Now, one standard I had left behind, which was IND AS 32. So there is a complete family of standard for financial instruments, which is IND AS 32, IND AS 107, and IND AS 109. And friends, financial instruments is the most important standard under the IND AS because this is completely new, and your each and every component of balance sheet has to be analyzed whether it is a financial instrument or not. And if it is a financial instrument, there is a complete criteria about how to classify that financial instrument, whether it is a financial asset, financial liability, or a equity, how to classify it, how to measure it at a reporting date, and how to disclose it. So the classification criteria are very extensive. The disclosures are very extensive, and it is very critical. So it is one of the most difficult standard under the IND AS or under the IFRS regime. And the second family of standard is IND AS 110, IND AS 111, IND AS 112. So this is for the purpose of the consolidated financial statements, how to prepare a consolidated financial statements, which entities you can consolidate, for which you have optional exemptions, you might not even consolidate, how to consolidate, and in what cases you have to measure it at fair value. Everything is given under this standard, and even IND AS 103, which is business combination standard, is also a part of this family itself. So this is about the consolidation standards. Then under IND AS, you also have a specific standard on the fair value measurement. So fair value measurement is nothing but in any of the standard, if it says fair value, you have to come back to this standard and check how to measure the fair value in accordance with IND AS. So this standard has given methods of fair valuation, which market to use, what are market participants, which is the best market, how to arrive at a fair value, what should be the common base of fair value. Everything has been given under IND AS 113, which is called as fair value measurement. Then you have IND AS 115 and 116. So as I previously discussed, these standards have replaced the old revenue standard and the old leases standard. Leases standard had explained you what is the basic logic. Under IND AS 115, which is a revenue standard, they have given a 5-step model. So based on this 5-step model, you have to decide what should be the revenue recognition for a particular company. And this revenue recognition standard has brought a drastic change, mainly in case of construction companies, in case of retail market or retail trading companies who issue a lot of schemes to the customers. So they have undergone a most important changes in case of application of IND AS 115. So this was a brief overview about what all standards are covered under IND AS. Let's understand the application fundamentals of IND AS. And again, this is my most important part of my session, so that you have a understanding of how you need to apply the IND AS, where should the differences go. You might have seen the companies which disclose their first IND AS financial statements, they disclose 3 balance sheets in their financial statements. So why are 3 balance sheets required? In which cases are 3 balance sheets required? Everything has to be discussed, or I'm going to discuss in this fundamentals of IND AS, fundamentals of application of IND AS. So friends, moving ahead, whenever the IND AS is applicable to a company for the first time, in such cases, what has to be disclosed? So for example, if you're falling into the phase 1, so if you're falling into the phase 1 of the roadmap of the MCA, in such cases, you have to disclose the first IND AS financial statements as on 31st March 2017. So on and whole, financial year 16-17 is your first IND AS financial statements. And accordingly, what are the requirements are given under IND AS? So these all requirements are given in IND AS 101. What does the standard say is, for the companies who are applying IND AS for the first time, they have to give comparatives as on the previous year. So previous year comparatives have to be given, and the opening balance sheet has to be given, which is nothing but opening date of the previous comparative year. So if your first financial statements are disclosed in 16-17, you will have a comparative financial which is called as financial year, which is called as 15-16, and you would have a opening balance sheet as on the opening date of your comparative year. So in short, your P&L would have 2 columns, which is 16-17 and 15-16. Your balance sheet would have 3 columns, which is 31st March 17, 31st March 16, and 1st April 15. These are the 3 dates of balance sheet which would be there in your first IND AS financial statements. And friends, for the companies which are listed companies, your first financial statements would be quarterly financials itself. So your 30th June 2016 or 30th June of the applicable year will be the year in which your first financial statements will be disclosed. So even over here, SEBI has given various guidelines which columns to disclose, which columns not to be disclosed. Everything has been given by SEBI. So to give you a glimpse over it, or to explain to you, it is your current quarter will be your first quarter, I mean the first IND AS quarter that will be disclosed. Your comparative quarter, that is 30th June 2015, will be the comparative quarter that will be given. Your complete year, that is 31st March 2016, has to be given as a part of your quarterly results. So in this form, your first quarterly results will have 3 P&L columns, and SEBI on periodic basis tries to issue certain exemptions for the purpose of disclosing the columns in your IND AS reporting. Now friends, moving ahead. Under IND AS, what are the components of your financial statements? So what does it mean? We'll discuss each and every component one by one. What has to be disclosed in each and every component, and how to understand it with practical examples. So first component is, as I discussed, the balance sheet. So the balance sheet is nothing but under IFRS, this is called as Statement of Financial Position, SOFP. Then you have a statement of profit and loss and other comprehensive income. So balance sheet is nothing, it is similar. Statement of P&L is also similar. What is new is this other comprehensive income. So let's understand this in detail. Friends, I've seen so many people who till now, even after application of this IND AS in a detailed manner, till now they cannot understand what exactly the OCI is. Or many people who have applied IND AS or to whom it is applicable, still they do not understand this concept of OCI. So let's discuss this also in the detailed manner. Now, OCI is nothing but an additional statement to the statement of profit and loss. Under IND AS, they have defined certain particular transactions which are rent expenditure account, or you have repairs and maintenance account. How all these expenditures are transferred to statement of profit and loss at the time of financial reporting. In similar manner, they have disclosed certain transactions which are to be routed through other comprehensive income. So these are obviously certain gain or loss positions. So these are profit items or gain loss items itself. But these items are not to be transferred to P&L, but these items are to be transferred a additional statement, which is like a profit and loss itself, which is in addition to the P&L, which is called as statement of other comprehensive income, also called as OCI. Okay, so for example, I'll just give an example. And what is the purpose of this classification? So the main purpose of this classification is many times the readers of the financial statements should understand what is the profit out of the normal activities or normal transactions of the company, and certain transactions which are not peculiar in nature or which are not out of normal routine activities of the company are been addressed by the standard, are been mentioned in the standard, and only these particular standards, because they should not hamper the profitability of the company on a day-to-day basis, they have to be disclosed in the other comprehensive income. Okay, so what are these items? And please understand, friends, you cannot apply a normal logic that these item is not in a routine nature of the company, and that is why I'll classify it to OCI. You don't have a discretion, friends. Only the items mentioned in the standard are to be disclosed as to be routed through OCI, and it is mandatory. Again, you don't have an option. You cannot say that instead of OCI, I will show it in P&L. It is not allowed. This is a purely rule based part of the standard. So as it is, you have to apply the concept, and as it is, you have to show in the other comprehensive income. So for example, investment in certain equity instruments which are not held for trading. So company is not holding it for trading, and company is not earning day-to-day profits out of it. So the gain or loss arising out of such instruments or such equity instruments, the entity has an option to disclose or to route these gains and losses through the other comprehensive income. And if this option is exercised, any kind of gain or loss from my investment has to be disclosed in the other comprehensive income. To explain it in further detail, for example, if I am a company, I am investing in my lot of group companies. So these investment in my group companies are to be fair valued at each reporting date. Now tell me, is the investment held for the purpose of trading? Am I gonna earn day-to-day profit out of my investment in the group companies? Obviously no. So at the option of the entity, they have given that you can route this gain or loss through the other comprehensive income. So what does it mean is, if my investment is of 100 and at a reporting date I fair value it at to 150, this 50 will not be shown as gain in my P&L, but will be shown as gain in my other comprehensive income. Second example, actual gains and losses, which is the most peculiar thing in any kind of company, as I've discussed before. Actual gains or losses are to be routed through other comprehensive income and are not to be transferred to the statement of profit and loss. So I'll show you one illustrative OCI. So this is the extract of a financial statements of a listed company. So up to there was tax expenses, above there was revenue, expenditure, PBT, everything is same. You arrive at profit for the year. Now, after arriving at profit for the year, you have a second part of the statement called as other comprehensive income. They have listed certain items. Only against these items, if you have any gain or loss, you have to disclose it over here. So, for example, gain or loss on remeasurement of defined benefit plan. This is nothing but your actual gains or losses. So the company had gain over it and they have disclosed it over here. And this item was not debited or credited to the employee benefit expenditure. It should appear only once. It is not a case that you will show it in P&L also, and you will just for the purpose of disclosure you will show it in OCI. This is not a disclosure statement only. You cannot show this item in your P&L, and accordingly your profit for the year does not include this gain of 32 lakhs. Then gain or loss on fair valuation of quoted investments in equity shares. So this company had a heavy loss of 49 of fair value adjustment. And again, your deferred tax standard also says that any kind of deferred tax on this OCI item has to be also shown it in the OCI itself. So if you have deferred tax on this item, they also have to be disclosed in the other comprehensive income itself. So if you will see, this is the profit for your year. This is the total other comprehensive income of 49,000, negative 49,000, and accordingly, your total comprehensive income is nothing but a loss of 36,000. So one more important thing, friends, even your EPS is computed only on the profit for the year. These are the items which should not impact your day-to-day profitability, and that is why even your basic and diluted EPS is also computed on the profit for the year component only. Okay, so this is the case in case of the other comprehensive income. And this is the most important concept to be understood. I have tried to simplify it as much as possible. Now, the third statement, which is called as statement of changes in equity. This is also a new statement under the IND AS regime. Statement of changes in equity is nothing but a statement which shows the entire movement of equity from opening to closing. So, as on 31st March 2019, I will show the movement of equity of the current year. So, what was the opening equity as on 1st April 2018? What are the changes in the equity during the year? And what is the closing equity as on 31st March 2019? I will also show this movement in the previous year, which is my comparative year. So I'll show 1st April 17, movement for the period and 31st March 2018. Now friends, equity includes both your equity share capital as well as all the reserves and surpluses, all the reserves which will form a part of the reserves and surplus. Not only this, the statement of changes in equity will also include the movement in the minority interest in your CFS. Minority interest is also called as non-controlling interest in your CFS, in your consolidated financial statements. So you'll show your movement in non-controlling interest. You will show the movement in minority interest in your CFS. You will show the movement in non-controlling interest in your CFS. You will show the movement in minority interest in your CFS. You will show the movement in non-controlling interest in your CFS. You will show the movement in minority interest in your CFS. You will show the movement in non-controlling interest in your CFS. You will show the movement in minority interest in your CFS. You will show the movement in non-controlling interest in your CFS. You will show the movement in minority interest in your CFS. You will show the movement in non-controlling interest in your CFS. You will show the movement in minority interest in your CFS. You will show the movement in non-controlling interest in your CFS. You will show the movement in minority interest in your CFS. You will show the movement in non-controlling interest in your CFS. You will show the movement in minority interest in your CFS.
Hello. I think some internet connection issue with Shweta. Let's see if she can join within 2-3 minutes. Hello Neha, can you hear me? Yes. So I think some internet connection issue was there. Uh, Let's wait for 2-3 minutes. Might be she have some internet issues. So
Yeah.
yes, Shweta, can you
So,
hear me? Yes,
yeah.
She's back.
Sorry for the disconnection, friends. I'll just continue.
yes, please.
Yeah. Just a minute. Yeah. So I hope you all can see my screen, friends.
Yes, yes.
Yeah. So sorry for the interruption. Moving ahead to the equity and profit reconciliation for the first time adopters. So you have to disclose what was your previous equity under your previous gap, what is your profit under the previous gap, and what is the profit under the current gap. So friends, to give you more details over it, for example, if you are a phase one company, in such cases, your first financial year or your first financial year reporting is 2016-17. For 2016-17, you only have your IND AS financial statements. But for a comparative year, which is 2015-16, you had financial statements under Indian GAAP also, and you have converged to IND AS, and you have comparative financial statements for the year 15-16 also. So for one particular year, you have two profit and loss. Then your balance sheet is on 1st April 15 and your balance sheet is on 31st March 2016. You have two balance sheets, which is under Indian GAAP also and which is under IND AS also. So only for these two balance sheets and only for one profit and loss, you have to disclose a reconciliation. So you don't have to disclose a reconciliation for your current financial year, but only for the financial year for which you had the two statements, that was which you had published under Indian GAAP also and which you had to publish under the IND AS also. For these two items, equity and profit reconciliation is required. Now, moving ahead to the next part, which is the format in which you will disclose the financial statements. Now, friends, under the IND AS regime, you have a Schedule 3. You had it for your Indian GAAP also, but for the IND AS companies, you have Division 2 to the Schedule 3. So if you are following IND AS, then for the purpose of format of balance sheet and format of P&L, you have to go to the Division 2 of the Schedule 3 to the Companies Act. And for NBFC companies, you will have to go to the Division 3 to the Schedule 3 to the Companies Act. This Division 2 and Division 3 discloses what is the format in which the balance sheet and P&L has to be disclosed. Now, OCI I have discussed in detail format. I'll also show an illustration of a listed company for the statement of changes in equity. So you have the opening, you have equity share capital and you have other equity. You have as on the opening date, comparative year end and the current year end. You have to show all the movements in this equity share capital. Then you have other equity. You have all the components. You have securities premium, general reserve, capital reserve, share options outstanding reserve, nothing but the ESOP reserve, equity instruments through OCI as I've discussed, and the surplus in the statement of profit and loss. And you have one more component which is called as the non-controlling interest component. So this is the illustrative statement of changes in equity, which is a format of one of the listed companies. Now, as we discussed, you have to transit from Indian GAAP to IND AS. But now you'll say, where should this resulting adjustment be transferred? For example, if one particular item had to be measured at rupees 100 under your Indian GAAP, and that is why your balance sheet was disclosing the asset at rupees 100. But after application of the IND AS principles, the value of that item is say 120. That instrument has to be recognized at 120. So one of the classic example is investments. Investments under your Indian GAAP had to be recognized at cost or market value, whichever is lower. But under IND AS, all the investments by default have to be recognized at fair value. So if you have an investment in mutual fund, so cost of which is 100, under IND AS, you have to disclose it at 120. What to do of this 20? How to give this impact? Where to give this impact is the question. So all the guidance have been given under the IND AS 101. So what does IND AS 101 say? You have to apply consistent accounting policies. So for your all the balance sheets, that is your current year, your comparative year, and your opening balance sheet, for all these three balance sheets, there should be consistent accounting policies. For your current P&L and the previous year P&L, there should be consistent policies. So in short, you have to apply IND AS to all the five items. Okay. Now it says how to transit. So what does the standard say is, if certain assets and liabilities are to be recognized under IND AS which are not required under your Indian GAAP, recognize it. If there are certain assets and liabilities which were recognized under Indian GAAP and are not required under IND AS, de-recognize such assets and liabilities. If any regrouping or reclassification is required, reclassify it. So if you see the schedule 3, there's a drastic change in the balance sheet. Your Indian GAAP balance sheet starts at liabilities. Your IND AS balance sheet starts with assets. Under your Indian GAAP, you had only current and non-current classification. Under IND AS, you have current and non-current classification also, and also you have classification into financial and non-financial items. So in assets also you have financial assets and you have non-financial assets. In liabilities also you have financial liabilities and non-financial liabilities. So, if for the purpose of such IND AS financial statements, whatever regrouping or reclassification will require, IND AS 101 says that reclassify and regroup such items. And the last part is remeasurement. So, if a particular item was, as I discussed, was to be disclosed at 100, now it is required at 120, disclose it at or remeasure it at 120. So, four changes: recognize, derecognize, regroup, public, reclassify, and remeasurement, which is required under IND AS. Now, the standard says whatever are the resulting adjustments on account of recognition, derecognition, or remeasurement have to be recognized in retained earnings as on the opening balance sheet date or any other appropriate reserve, whichever is appropriate to that particular transaction. So understand, friends, if you are applying IND AS for the first time on 31st March 2017, for example, your opening balance sheet date is 1st April 2015. So for whatever transactions happened before 31st March 2015, and if there is any IND AS adjustment required, so you had a investment in mutual funds as on 31st March 2015 at 100 rupees, you will disclose or you will recognize the additional increment of 20 rupees in retained earnings. So what will be your accounting entry is investment in mutual funds account debit 20 to retained earnings 20. So whatever was the gain on account of remeasurement in accordance with IND AS has been recognized into retained earnings in the opening balance sheet date. Okay. Now, if any derecognition is required, so if this particular asset is not required itself in IND AS, and on account of that you have to write off this asset, you will recognize it in retained earnings itself. So retained earnings becomes your basket. So whatever is debit or credit, you do it into the retained earnings or any other appropriate reserve as applicable. So if you are doing a transition of ESOP, if there is change in method, so previously you were following the intrinsic value method, but under IND AS, this method is not allowed. So in such cases, whatever is the difference, one leg will go to the retained earnings and one leg will go to the ESOP reserve. So this is the case. And please understand standard rule. All IND AS as good as are applicable from a retrospective basis, unless there are any exemptions given. So understand this concept also. IND AS 101 has given certain optional exemptions and certain mandatory exceptions. What does this mean? Optional exemption means what? The company has an option that they might use this exemption or they might not use this exemption. So for the purpose of smooth transition from your Indian GAAP to IND AS, they have given certain optional exemptions. If you're okay with it, use it. If you're not okay with it, do not use it. For example, one of the example is, if in case of your property, plant and equipment, the standard says that you can carry your Indian GAAP values as it is do not make any changes to the property, plant and equipment except one or two. So the company has an option. If they want, they can apply the entire standard of IND AS on a retrospective basis, or they can use this optional exemption and carry that Indian GAAP values as it is to IND AS. No adjustment required. This is for the purpose of smooth transition. The companies have assets from 1950s, 1960s, from where they will go and make adjustment to such kind of assets. That is why the company has given this exception for a smooth transition. And the second part is mandatory exceptions. What does this mean? This is mandatory in nature. If a particular standard, the IND AS 101 said that mandatorily you have to apply this exception, you don't have any other option. So mandatory exceptions are given in case of, say, government grants. So in case of particular government grants, it has been mandatorily stated that you have to carry the value of that value of the liability as it is. All the conditions are mentioned. But such are the examples where the entity does not have an option. Even if it wants, it cannot carry that government grant value in accordance with IND AS, and they have to follow as it is whatever was given under the AS for the purpose of transiting to the IND AS. So this is the case of how to give the resulting impacts and how to transit to IND AS. I hope I've clarified and given you an overview of complete things to whom the IND AS is applicable and how to transit for it. At least for the smaller companies, it will be very easy for you to transit if it does not have the peculiar issues into it, or if it does not have any complex transactions into it. Moving ahead to the next important part, which is I have discussed majorly everything, but let's also discuss what is the view of the ITFG. So ITFG is nothing but the IND AS Transition Facilitation Group. So in case if you have any queries or if you have any expert views required, you can at any time write on to the ITFG about your case of the application. Then the ITFG gives their view over such cases. What are their view? What treatment should be given to it, and what are the provisions of the standard? So let's discuss the ITFG issues on application of IND AS. So let's discuss the issues quickly. Applicability of IND AS subsidiaries of listed company. So this was a case where the querist had asked if a particular subsidiary, we have discussed already that if the IND AS is applicable to the holding company, it is also applicable to the subsidiary company. Now, what the query was, if the subsidiary was the subsidiary as on the previous year, but in the year of actual implementation of the IND AS, it is no longer a subsidiary. So for example, in 2016-17 is the live year of IND AS, but on 1st June 2016 itself, the subsidiary was hived off. So in spite of the case that subsidiary is hived off, still on 31st March 2017, the subsidiary has to disclose the financial statements under IND AS, because the primary logic of IND AS is once it is applicable forever. Then the second case under this itself query was that if a subsidiary has been newly acquired in that particular financial year. So if my 2016-17 is a live year of IND AS application, and I have purchased or I have invested in a new company, which is my subsidiary eventually on 31st December 2016. In spite of the case, you have to apply for that subsidiary also in its own standalone balance sheet. IND AS will be applicable as on 31st March 2017. The next query is applicability of IND AS to Indian branch office of a foreign company. For the purpose of Indian branch office, the IND AS is not applicable even if the net worth of that branch office is more than the limits prescribed. Why? Because all this application of IND AS is mainly to the corporate entities, to the companies which are registered under the Companies Act. Branch office is merely an extension of the foreign company, and accordingly to such branch offices, IND AS is not applicable. Third, applicability of IND AS to non-corporate entities. Again, it is not required for the non-corporate entities. For non-corporate entities such as partnership firms, your accounting standards are mandatory as issued by ICAI, but IND AS is not required to be followed for such non-corporate entities. Fourth, applicability of IND AS to Section 8 companies. For the purpose of Section 8 companies, IND AS is applicable. So for example, if you have a holding company and the subsidiary company of such holding company is a Section 8 company, even to such Section 8 company, IND AS is applicable. There is no exemption to Section 8 companies, even under Section 133 of the Companies Act, or even under Section 129 of the Companies Act, and accordingly, for such Section 8 companies, IND AS is applicable. Then next query. Applicability of IND AS to holding company when subsidiary company meets the criteria for applicability of IND AS. So in this case, what was the case is subsidiary meets the initial the criteria to apply the IND AS, and what to do about the holding company. So as it is said that it is a group level, if it is applicable to the subsidiary company, it is also applicable to the holding company by default. Then so no question arises further. Next, applicability of IND AS to associate company in case of quarterly results. So what was the case over here is the subsidiary company. So if your quarterly results are as on 30th September 2020, for example, the associate company, the company invested into an associate company on 10th of October 2020. So what is the case is before finalizing the results of the company, they have invested into the associate company. Now what should the associate do? For example, if both are the listed companies, so what to do? Or if suppose they are not the listed companies, in such cases what to do? So what has been said is that if you have invested into the company after the quarterly date is over, after 30th September, you should not consolidate the associate company as on 30th September. IND AS is not applicable to the associate company for the quarter of 30th September, and it will be applicable from 31st December quarter. So even for the purpose of consolidation, you will consolidate that associate under IND AS from 31st of December. Moving ahead to the next question. Applicability of IND AS to holding subsidiary joint venture and associate company through a direct or indirect association in case of voluntary adoption by parents. Now here there are two questions. So the question was asked is if it is not a direct subsidiary but it is an indirect subsidiary. What does an indirect subsidiary mean? Subsidiary of a subsidiary. So in that cases whether it will be applicable. So the answer provided was in any cases, whether it is your own subsidiary or whether it is your indirect subsidiary or even if it is your fifth level of subsidiary, in any cases, if it is considered to be your own subsidiary, then directly or indirectly does not make a difference. IND AS will be applicable to all such companies. Even associate of a subsidiary company is your own associate. Even to such associates also IND AS is applicable. So please, in any kind of huge group structures, do not miss on to the appropriate application for the purpose of this IND AS. Now the second part of the query was any companies, if suppose even if I have not reached the net worth criteria, even if I have not reached the net worth of 250 crores, still I have a voluntary adoption option available to me. I can apply the IND AS voluntarily. So in such cases, what to do? Whether all the holding subsidiary, everyone the IND AS had to be applied? Yes. Even if any particular company adopts IND AS voluntarily, all the companies linked to it, holding subsidiary, associate, joint venture, to everyone IND AS will be applicable. You won't see that since they have applied voluntarily, we won't apply. This is not the case. So voluntarily or by the purpose of application of the provisions, by default the IND AS is applicable to such kind of companies. Moving ahead to the next ITFG, computation of net worth for IND AS applicability, government grant to be considered as capital reserve. Whether capital reserve will form a part of the net worth for the purpose of determining whether the criteria is met or not. Yes, the capital reserve will be considered in the net worth definition for the purpose of determining whether IND AS is applicable or not. Next, applicability of IND AS in case of negative net worth. The query raised over here was, I am the holding company, to me IND AS is applicable. But to the subsidiary company, they have negative net worth. They don't even have the net worth, whether IND AS should be applicable to them or not. They are getting IND AS applied due to their subsidiary, due to that company is your own subsidiary company. Even if the net worth is negative, does not make a difference. IND AS will be applicable to such kind of companies. So in case of group structure, even if one company is triggered, all the companies are triggered under IND AS. One more important issue what was raised under ITFG was, in accordance with what you should determine whether a company is a holding, whether a company is a subsidiary company, associate, or a joint venture. Now, understand, friends, the definition or the determination criteria under IND AS and under AS is different. So there might be a case that a company was not a subsidiary company under Indian GAAP, but is a subsidiary under IND AS. A particular company was not a joint venture under Indian GAAP, but is a joint venture under IND AS. So what to do in that case? So the ITFG has clarified that you will have to apply the definition of IND AS to determine whether a particular company is a subsidiary holding or a subsidiary joint venture or a associate company. And if a company is subsidiary as per that definitions, IND AS is applicable to them by default. So don't see the guidance given under Indian GAAP, but see whether a particular subsidiary is a subsidiary in accordance with the IND AS or not. So these are the various ITFG issued, and whenever you have time, please go through the compendium of ITFGs issued by ICI. They clarify lot many issues given under the IND AS. It will increase your grip over these standards. So friends, this is all about the IND AS. I hope you have enjoyed the lecture, and I could clarify most of the issues. At least you have awakened where all to see the guidance under IND AS, what are the norms under IND AS, how to read the financial statements under IND AS. Briefly, I could cover the major or the practical differences under the majority of the standards. If you have any queries, I guess we can open the lines for the queries, and I'll try to resolve all the queries.
Yes,
So,
few queries are there. I request Neha to please take the queries. Yes, please.
yeah.
Open
There
your
was a
screen.
query from Navneet, which mentioned that what happened if a subsidiary does not remain a subsidiary in a subsequent year.
Yeah. So if IND AS is applicable to a particular company, if you're going by the phase one and phase two norms, they had given a particular date on which you have to see whether the application of IND AS is there or not. According to that norms, if the IND AS is applicable to a subsidiary company, it is applicable forever. You cannot get out of the IND AS regime thereafter. So this is a reply to his query.
Okay, the next query we have is agricultural land, which if it's given on rent, is it an investment property?
Agricultural land, if it is given on rent, yeah, it is
Rent.
an investment property.
Okay.
It is a agricultural land given on rent is a investment property. There is no distinct to that. There is no question whether it is agricultural land or a non-agricultural land. So any kind of
And
land or building given on rent or held for the purpose of capital appreciation is an investment property. So this standard also covers if you have an unintended use of land. So what does it mean? If today I don't have an intention ki whether I'll use it for my business or whether I'll rent it or whether I'll sell it. If I don't have clear-cut intentions, still it will be my investment property. This is given under the standard.
great. Next question, which we had was what is the corresponding IND AS of AS13?
Of AS13 investments. So AS13 you had only investments, but under IND AS you have a broader family of standard which is the financial instruments. So you have IND AS 32, you have IND AS 109, and you have IND AS 107. So you have to read all these three standards, and these are the most complex standards.
So we can move to the next one.
Yeah, yeah,
Yes, one request is there, Shweta ji. If we
yeah.
can conduct in further, please Neha बताओ आप.
Shweta, people liked your seminar so much that now they want you to have a session on individual IND AS, some specific
Okay,
ones
okay.
like financial
Yeah.
instruments, PPEs, etc.
Yeah,
If
yeah, yeah.
that's possible,
Thank you,
it would be
friends.
great.
Thank you so much for listening to me so patiently and trying to understand each and every session, each and every part. I know for the ones who have heard this Indies concepts for the first time, it might be difficult to grasp, but I tried my best to simplify it. And if any of you have any further queries, you can write it down on my email ID also. So I'll try
Yes.
to reply any basic or any small queries. And yeah, thank you so much.
Yeah, few more queries are there. Let's see.
Yeah, yeah, yeah. Tell me, sir.
A couple of more queries.
Yeah,
If a parent company is outside India and the subsidiary is
yeah.
in India, whether
Mm.
IND AS would be applicable in that case?
You will only check for the subsidiary company. So if the subsidiary company is meeting the criteria of the net worth, then the index is applicable to the subsidiary. But if the parent is preparing an IFRS and that is why to you index is applicable, this is not the case.
Okay.
So you will just check individually based on the own subsidiary what are the net worth criteria, whether it is meeting the criteria or not.
Okay. Uh, can you share some more detail on valuation of unquoted investment in non-subsidiary company?
In a non-subsidiary company. Yeah. So
Yes.
there is a different standard or there is a particular standard over it, which is IND AS 113 fair value measurements. This standard has given three methods, which is income approach, market approach, or cost approach. Using these three approaches, you have to value the investment. So in short, what is not allowed is you cannot purely use the book values for the purpose of measurement of investment. So in short, DCF is allowed. Your PE price earnings multiple is allowed for the purpose of measuring unquoted investments. Then your market approach is also allowed. You can take the beta of a similar listed company. You can take CAPM of a comparable listed company, and accordingly you can use a discount rate to the cash flows of your unquoted investment in the shares. It is a pure valuation theory that you will use, and to give a short guideline is what you should not use have discussed and what you should use have discussed. Yeah. So next.
Perfect. And maybe one of the last query is the format of statement of changes in equity given in Division 2 of Schedule 3 fixed, or can someone make changes to it as per their own requirements?
Yeah, so changes which are giving additional information, obviously they are welcome. But as a structure as a whole, you have to maintain the same structure. How balance sheet you maintain the same structure, and you have to give additional line items. You give additional line items in the balance sheet. Similar under a statement of changes in equity, also you keep the same structure. So ideally, you tend on to maintain the same format itself. So changes in what form? If you have any specific, you can share. But I don't foresee in my entire thing that they have changed the structure of the changing structure is not allowed. You have to use the format given under Division 2. But any additional information you can obviously incorporate in the same format.
Perfect. Another one, statement of change in equity is applicable to private companies also?
Yeah, all to whichever companies index is applicable to all such companies. Whatever components of financial statements I've discussed, there is no exemption to any company. To everyone, it is applicable.
So thank you very much, Shweta ji, for
Yeah, thank you, sir.
such a wonderful presentation on the overview and then applicability and then how to implement it. So really, it's a good thing, and we'll request you for further date for some individual, as some members are requesting us to organize some few more webinars. So
Yeah,
definitely we'll take time from you. And my sincere thanks to Neha also for organizing such a wonderful this webinar. So, and
Always a
thank you
pleasure.
very much to all of you for joining. We'll come with another webinar. So thanks a lot. Thank you very much.
thank you so
Thank
much, sir.
you.
Thank you. Yeah.